Hello, aspiring traders. Welcome to our channel. Today, we will guide you through the top 5 proven trading strategies for beginners. If you're new here, don't forget to subscribe and hit the bell icon to stay updated with our latest videos. Starting your trading journey can be overwhelming, but with the right strategies, you can navigate the markets confidently. In this video, we'll break down 5 beginner-friendly strategies: trend following, breakout trading, mean reversion, moving averages, and the RSI strategy. Each strategy is designed to be straightforward yet effective, helping you make informed trading decisions. Let's dive in. First up is the trend following strategy. The idea behind trend following is simple: buy when the market is in an uptrend and sell when it is in a downtrend. This strategy is based on the premise that markets tend to move in a particular direction for a significant period. To identify trends, you can use tools like moving averages. For instance, when the short-term moving average crosses above the long-term moving average, it signals an uptrend, and vice versa. Trend following is advantageous because it allows you to capture significant market moves. However, it's important to note that this strategy works best in trending markets and may not be as effective in sideways or choppy markets. To enhance your trend following strategy, consider combining it with other indicators like the Relative Strength Index (RSI) to confirm the strength of the trend. Next, we have breakout trading. Breakout trading involves entering a trade when the price breaks out of a defined range or chart pattern. This strategy is effective because breakouts often lead to significant price movements. Common breakout patterns include triangles, rectangles, and head and shoulders. To implement this strategy, identify key support and resistance levels and wait for the price to break above or below these levels. For example, if a stock has been trading between $50 and $55 for several weeks and then breaks above $55, this could signal the start of a new uptrend. Place your entry order just above the breakout level and set your stop loss slightly below the breakout point to manage your risk. Breakout trading requires patience and discipline, as false breakouts can occur. To reduce the likelihood of false breakouts, look for confirmation from increased trading volume or other technical indicators. Our third strategy is mean reversion. Mean reversion is based on the concept that prices tend to revert to their historical average over time. This strategy works well in ranging markets where prices oscillate between established support and resistance levels. To implement mean reversion, identify assets that are overbought or oversold using indicators like the RSI or Bollinger Bands. When an asset is overbought, it's likely to revert to its mean, presenting a selling opportunity. Conversely, when an asset is oversold, it's likely to revert to its mean, presenting a buying opportunity. For instance, if the RSI of a stock indicates it is overbought above 70, you might consider selling or shorting the stock. If the RSI indicates it is oversold below 30, you might consider buying the stock. Remember to set your stop-loss orders to protect against unexpected market moves. Moving averages is our fourth strategy. Moving averages smooth out price data to create a single flowing line, making it easier to identify the direction of the trend. The two most common types are the simple moving average SMA and the exponential moving average EMA. The SMA calculates the average price over a specific number of periods, while the EMA gives more weight to recent prices, making it more responsive to new information. One popular method is the moving average crossover strategy. This involves using two moving averages of different lengths, for example, a 50-day SMA and a 200-day SMA. When the shorter-term moving average crosses above the longer-term moving average, it signals a potential buy opportunity. Conversely, when the shorter-term moving average crosses below the longer-term moving average, it signals a potential sell opportunity. Finally, we have the RSI strategy. The Relative Strength Index (RSI) is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is typically used to identify overbought or oversold conditions in the market. An RSI above 70 indicates that an asset may be overbought, while an RSI below 30 indicates that an asset may be oversold. The RSI strategy is simple: buy when the RSI crosses above 30 and sell when the RSI crosses below 70. This strategy is effective because it helps you identify potential reversal points in the market. However, it's important to use the RSI in conjunction with other indicators to confirm signals and avoid false entries. For example, if the RSI indicates an oversold condition, you might also look for bullish candlestick patterns or support levels to confirm your entry. To summarize, the 5 trading strategies we've explored today are trend following, breakout trading, mean reversion, moving averages, and the RSI strategy. Each of these strategies offers a unique approach to the market, and with practice, you can determine which one aligns best with your trading style and goals. Remember, the key to successful trading lies in consistency and continuous learning. As a beginner, it's vital to start with a solid foundation and gradually build your skills and knowledge. Practice these strategies in a demo account before applying them in the real market. Keep a trading journal to track your progress and learn from your experiences. Trading is not just about making profits, it's also about understanding the market dynamics, managing risks, and continuously adapting to changing conditions. Staying informed about global economic events, corporate news, and market trends can significantly enhance your trading decisions. Utilize various resources such as financial news websites, trading forums, and educational content to stay updated and sharpen your trading acumen. Moreover, developing a disciplined mindset is crucial for long-term success in trading. Emotions like fear and greed can often lead to impulsive decisions that may harm your trading performance. Implementing a well-defined trading plan and adhering to it strictly can help you stay focused and avoid emotional pitfalls. Set realistic goals and be patient with your progress. Trading is a marathon, not a sprint. Another crucial aspect to consider is risk management. Even the best trading strategies can result in losses if proper risk management techniques are not applied. Always use stop-loss orders to limit potential losses and never risk more than a small percentage of your trading capital on a single trade. Diversifying your portfolio can also help spread risk and protect your investments. Technical analysis is another vital component of successful trading. Learning how to read charts and understand various technical indicators can provide valuable insights into market trends and potential price movements. Combine technical analysis with fundamental analysis to get a comprehensive view of the market. Fundamental analysis involves evaluating economic indicators, financial statements, and other relevant data to assess the intrinsic value of an asset. If you enjoyed this video, please give it a like and share it with other aspiring traders. And if you have any questions or suggestions, leave them in the comments below. We're here to help you on your trading journey. By engaging with our community, you can gain valuable insights, share experiences, and grow together as traders. Thank you for watching, and until next time, happy trading.